Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing clean energy fuel stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Clean Energy Fuels is best known for collecting and transporting renewable natural gas that is produced from animal waste. The company is headquartered in Newport Beach, California, and was founded in 2001. It started trading in 2007 and can be found on the Nasdaq, Deutsche Börse, and London Stock Exchange. This company has been getting a lot of recognition because of its deals with Chevron, Total, BP, and the retail giant Amazon. It fuels 560 gas stations across the US and Canada using compressed natural gas, liquefied natural gas, and renewable natural gas. Most of the company's hype comes from its focus on expanding its RNG business. RNG stands for renewable natural gas. RNG is produced when organic waste from landfills, dairy farms, and other sources decomposes and releases methane gas, which is then further processed and purified. RNG is viewed as a clean fuel and is classified as a carbon negative, since cow waste is a key source of greenhouse gas emissions. And by using this, it takes more carbon out of the environment than it produces. This makes the fuel very attractive from an environmental standpoint, and governments are incentivizing companies with lucrative federal and state tax credits. The outlook for Clean Energy Fuels financials is very positive. The company's leading position in the renewable natural gas space, the sizable market potential, regulatory support under the Biden administration make the stock very appealing. The company has also been a trending ticker on Wall Street Bets for several months now. Let's get started with the model. This is a small cap company, 1.7 billion market cap. They're trading at $7.76 a share, and they have 223 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow in 3 of the 4 years. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative in 3 of the 4 years. Revenue is the sales for the company, and that doesn't look so good, declining each year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that decreased from 81 million to 52 million. Then below that is operating expenses. Examples are depreciation and marketing. Then below that is operating income, which was positive in 2018 and 19, negative in 2020 and the trailing 12 months. They paid 6.6 million of interest on their debt, and that's the lowest they paid in the past few years, so it looks like they're decreasing their debt load. And they don't pay much in taxes because they have negative net income, plus they got a lot of tax credits for what they're doing. So the bottom line of the income statement is their net income, which is negative every year except in 2019. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You can think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they are generating positive operating cash flow, even though they had negative net income most years. So that is a good sign, because the income statement has a lot of non-cash expenses that bring down your net income, like depreciation, stock-based compensation. And they also spend quite a bit in CapEx, $27 million a year. It dropped to 13 million in 2020. In order to process the waste and turn it into natural gas, they need expensive machinery. Operating cash flow minus CapEx gives you your free cash flow. And they do have positive free cash flow in 3 of the 4 years. So they did issue 83 million of capital stock in 2018, but they paid down almost $200 million of debt in 2018. With their positive free cash flow, they bought back 15 million of stock in 2020. So even though their revenue is down, which is concerning, they're still generating positive free cash flow. Without all the government credits, it would make it more difficult for this company to become profitable. But as they grow and get bigger, they should be profitable without the tax credits. This is the equity section of the company's balance sheet. So they raised $1.2 billion by selling stock. And historically, they lost about $700 million. So it doesn't look so great, but it does take time to become profitable and make money. Their revenue still isn't that high, but if they continue growing, which they should, because this is a really important sector, the whole world, especially this country, is focused on cleaner, renewable energy. So somebody needs to be there to do all the work, whether it's this company or another company. And if you're invested in this company, I'm sure you're hoping they're the ones that take in all the revenue. Let's look at their capital structure. 512 million of equity, 126 million of debt. They're 80% equity, 20% debt. And their net debt is negative, so they could pay off all the debt with the cash on their balance sheet if they wanted to. and their weighted average cost of capital is 9.5%. Most companies have a weighted average cost of capital between 4 and 13%. I gave them a weighted average cost of capital a little on the higher side because historically they've been losing money and their revenue is down, so I think it is a risky investment. But if they can execute the plans in place, I think they can make a lot of money. They have a lot of big partners on their team. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $3.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.8 billion. We divide that by 223 million shares. And we get a calculated stock price of $12.37. They're trading at $7.76, so they're trading at a 37% discount. It is a buy according to the model, but I'm projecting the company will grow a lot the next few years. And they could definitely have a lot more free cash flow than $230 million by 2024. Because as the country gets more greener, this company should have a lot of opportunities to build its revenue streams. I do think the estimates were conservative, but I'm still not sold on the company executing its plans and becoming profitable. I think in a year or two, I may get more comfortable with them, but at this point, I'm not 100% sure. Simply Wall Street values the company at $21 a share, so they're saying it's even more undervalued than me. 3 analysts priced this stock and the average price target was $10.50. This is where the stock has been trading since it IPO'd. It started out about $15 it looks like. And then it looks like it peaked around $22. Then it came down a lot, around $3 I think at its lowest. Then when Biden got elected, it got a real big boost. Usually when a stock gets pushed up really quick, there is a pullback. This is where the stock has been trading the last 12 months. So before Biden got elected, it was at a really low point. And when the Biden administration kept talking about clean energy and all their initiatives, all clean energy stocks got a really big boost, as this did. Also around the time of the big boost, an article came out about this company having a contract with LA Metro for more than 47 million gallons of renewable natural gas. The company's revenue was still down, so it's not like they were becoming more profitable as their stock price went up. It's just all these news stories. So of course the stock price came down. But I'm not sure if it's going to come back down to $3 a share. I can't say this is the bottom, but I think we're getting pretty close to the bottom again. And they have a pretty high beta, 1.86, so the stock is a bit volatile. The stock has done well in the past 52 weeks, up over 200%. The S&P 500 is up 37%. The 52-week low was 234, the high was 1979. So that's quite a spread. The 52-week high was 8.5 times the 52-week low. The stock is in a decline. It's trading below its 50-day and 200-day moving average. And this is a pretty liquid stock. 7 million to 16 million shares are traded each day. Of the 223 million shares outstanding, 154 million are on float. 40% are held by institutions. And it has a pretty high short percentage. 10.5% of the shares on float are shorted. But the stock price has come down a lot, so the short percentage has come down. When the stock price was higher in January, the short percentage was much higher. And this stock has outperformed its industry and the market in the past year, 3 years, and 5 years. Analysts are bullish on this stock, projecting their earnings to grow 100% and its industry only 16%. Analysts are also projecting their revenue to grow a lot more than its industry. In the past 5 years, their annual earnings increased 34%, but in the past year, it's down 150%. If you invested $10,000 into this company 10 years ago, you would have lost half your investment. There were 2 times your investment would have been over $10,000, but for only a few weeks at a time, it would have went right back down to below $10,000. Total Energies owns 21% of the stock. All of Total Energy shares are not on float. They can't be purchased by anybody. And Total is one of the bigger oil and gas companies in the world, so it's good to have them as a partner. The next biggest shareholder is Dimensional Fund, BlackRock, State Street, and Vanguard. Let's look at their financial ratios. We can't look at the PE because they have negative net income. Their price to sales is decent, 6.1. That means investors are paying $6 for $1 revenue. I like to see a price to sales below 3. Their price to book is pretty good at 3.4. They have a high current ratio of 3.2 and a high quick ratio of 2.9. They have over $140 million of cash on their balance sheet. They have enough cash to cover all their current liabilities. They seem to be fairly well capitalized. They had $56 million of free cash flow in the trailing 12 months and about $200 million of working capital. So they have $250 million of excess funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 8 other companies in the same industry as Clean. And if Clean has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse than everything except current ratio and debt. So their ratios are a bit weak. The company is in growth mode, so it is common for those types of companies to have weak ratios. So to summarize, I have them trading at a 37% discount. And something that concerns me about companies like this, similar to a company like Tesla, they really rely on tax credits. Without tax credits, Tesla would not make that much money, or maybe even lose money. So ideally, I'd want to see them profitable without getting any government support, because the support could run out. But I don't have any numbers to back that up. This is just the inclination I see from looking at these types of companies. The good thing about owning stocks like this is they get a lot of attention. So the stock price can go up 2, 3, 4, 5 times before the company makes any money, because it's really about perception of the company. It's not what actually happens. In the long term, fundamentals dictate everything, but in the short term, it's about the perception, the hype, the news stories, and all the people talking about a stock. I rank their free cash flows 5 out of 10, their revenue 4 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.